Hey everyone, Domino's reported fiscal 2023 first quarter earnings results. I've reviewed the financial figures and I want to share them with you in this video, so let's begin. Domino's revenue increased slightly year over year to 1.024 billion. That was up from 1.011 billion year over year. Despite the modest revenue increase, the company boosted earnings per share to $2.93. This was up from $2.50 in the same quarter the prior year. Global retail sales growth increased by 5.9%, buoyed by price increases and new store additions. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Now remember, Domino's runs on mostly a franchise business model. It does own some of the locations, but mostly Domino's restaurants are run by franchisees, which then pay Domino's a royalty fee on these global retail sales. So for that reason, it's important for global sales to grow because that's how Domino's generates revenue from rising sales. Domino's added 128 net new stores in the first quarter, a relatively slow rate of growth to reach 20,008 locations worldwide. The biggest headwind to Domino's store development is labor shortages. The company can't find enough workers, primarily enough drivers. That's been the big headwind for Domino's coming out of the pandemic. Investors thought that coming out of the pandemic, people might feel a sort of pizza fatigue since demand for pizza soared when we were in lockdown, but that hasn't been the case. Demand for ordering pizza has remained really, really high. What's been harder for Domino's to do since economies reopen is to attract and retain employees because when economies started reopening, people had more job options. People could now drive for Lyft and Uber and DoorDash and others, and they could work at restaurants, they can work at hotels. So, all of those service sector areas that had new jobs open took people away from the labor force, and now Domino's has had difficulty staffing up. That's been their biggest challenge now for the better part of a year and a half or 2.5 years, ever since economies started reopening. So it's challenged Domino's. They've had to, pause new store development because they couldn't find enough workers for that new location. They've had to operate some stores at fewer hours because they didn't have enough staff to operate that store for as many hours. So it's been a really difficult challenge to overcome. And Domino's management on every earnings call since economy started reopening has been discussing this difficulty. Now, to combat some of these challenges, one thing that Domino's has done is to encourage people to order online and come pick up their order at the Domino's location. So instead of Domino's delivering it to you, they have you come pick it up at Domino's. That has not worked really well because the offer is not really enticing. Around my city, they offer you $3 to come pick up the pizza instead of having it delivered. And you can only use those $3 if you order Domino's again within the next week. So if you don't order it within a week, those $3 go away. So it's not really enticing to choose the pickup option. And, Domino's has been very careful with its spending. It hasn't said, you know what, we have labor shortages. Let's really pay higher wages to attract workers. They've been very careful with that. As they have been with these promotions, right? I mentioned how non-enticing that promotion was. That's been their strategy. They've been really careful not to overspend to solve this problem. And you could see that in their earnings per share. See, even though revenue had difficulty increasing, the earnings per share jumped because Domino's has been so careful in their cost structure because they didn't want to raise prices on consumers. They've only modestly increased menu pricing. They haven't really done these big menu price increases like other food companies have. And their goal is to continue to offer families a very, very low price for their products, which makes them attractive when you're deciding, if you don't want to cook one day, they want Domino's to be an attractive option, and it is. Their pricing makes it so that you can feed your family of four for less than $20 if you want to, right? And I think that's going to become more important if the economy goes into a recession because people will look to uh, affordable dining options if you choose not to cook. And then cash flow from operations also increased to 114.7 million, up from 78.8 million. So all of these figures are highlighting Domino's management strategy of not to overspend to solve this problem. They're, taking incremental steps to try and solve this problem and not just trying to say, you know what, let's go ahead and overspend to solve it, which I can appreciate as an investor. One thing to note here, Domino's has $5 billion in debt and cash of $154 million. This should say 5 billion in total debt. I missed putting that debt word in there, so sorry about that. But now this could become an increasing risk because interest rates have increased so much that when Domino's goes to refinance this debt, they're going to have to pay higher interest rates and higher interest expenses on that debt. So that it's a risk in that they're going to have to pay higher interest expense. It's not so much a risk in that they might not be able to pay that debt because as you can see, the company generates robust earnings and robust cash flow from operations enough to service that debt significantly. One final thing I will note, I had Domino's stock as a buy to start the year. I had recommended the stock a buy. But at some point, and you can go back and check my videos, around February and March, I took it off my buy list. I took Domino stock off my buy list, and it was in response to an update that management gave when they lowered their long-term growth targets, their 2 to 4 year long-term growth targets, because of this labor shortage trouble. They said that this is going to hurt the company for several years. And when I saw that, I said, okay, this is a bigger problem than I initially expected it to be. And so I no longer recommended Domino's stock as a buy. And I didn't see anything in these earnings results to change that recommendation. So Domino's is an incredible company. I definitely have this on my watch list, although I would not be buying this stock until I see more progress in that solution for labor shortages. All right, so that's all I've got for this video. Thank you so much for watching. If you enjoyed this video, I've got a lot of videos like this one. I cover over 100 companies during earnings season. So you're going to see a lot of earnings reviews, earnings previews, and you're also going to see buy and sell recommendations. You're going to see top stocks to buy. You're going to see deep dives and earnings call reviews. You get a lot of videos, a lot of content. I publish on average 4 videos, 5 videos per day. So if that sounds like something that interests you, please go ahead and subscribe. I would love to have you as a subscriber. Thank you so much, and I hope I'll see you soon.